Retained earnings is a concept that students often find confusing. We calculate it as net income minus net losses minus dividends. But what is it really? It's not a stash of money, darn it. It's accumulated over the corporation's life. Retained earnings is defined as the amount of net income left over for the business after it has paid out dividends to its shareholders. Often this profit is paid out to shareholders, but it can also be reinvested back into the company for growth purposes. The money not paid to shareholders counts as retained earnings. Dividends are one of the reasons most people buy stock in a corporation. They can take three forms. The most common is cash, but can also be stock or other assets. Let's take a closer look at cash dividends. For a company to pay cash dividends, they have to have enough money to pay it, obviously, and enough retained earnings to even talk about it, declare it. Once the board declares that a dividend will be paid, the company has an obligation to pay it. There are three dates that matter. The declaration date is when the company says they're going to pay the dividend. The company records that declaration with this entry: debit retained earnings and credit dividends payable. The next date is the date of record. This is the date that's basically the cutoff for who owns the stock and who gets the dividends. Since stocks are sold all the time, there has to be a date where the company says you get the dividend, but you don't. No journal entry is required for this. The payment date is the day the dividend is actually paid. The journal entry to record that is a debit to dividends payable and a credit to cash. Net income increases retained earnings. Net loss decreases retained earnings. Dividends declared reduce retained earnings, and so do a few other things. The only thing that increases it is net income. An example of playing with the numbers, you know how to figure out the one you don't. Let me rephrase that. An example of playing with the numbers you know to figure out the one you don't. In this case, you don't know dividends, but you know beginning and ending retained earnings and net income.